Good morning, ladies and gentlemen. I'm Grace from the fake practice of Fangda Partners, a Chinese law firm. So it's a great personal pleasure to be back to Hong Kong after the border reopens. And we have just heard a lot from the regulators, scholars, economists. Now let's hear the thoughts from the industry players. Let me invite my panelists, Dr. Huang from CICC. He is also actually a famous economist, chairman of Capital Market Committee of CICC, Dr. Huang. And Mr. Cao Shounian, chief executive of CCB Hong Kong Financial Market Center. He has in-depth knowledge of bonds market. Mr. Cao, please. And Mr. Xiaofeng Zhong, chairman of Amundi Greater China. Welcome, Mr. Zhong. We all know how successful Amundi's wealth management joint venture with BOC have been in China under the leadership of Mr. Zhong, please. And I think on the screen we also have, last but not least, Ms. Desiree Wang from JP Morgan. She is from Shanghai. So we have representatives in Hong Kong and Shanghai to speak about all the opportunities in China. Ms. Desiree Wang has JP Morgan's asset management business in China. Okay, I think today my panelists will share with you about the topic of how China can strengthen or further strengthen its attractiveness as an investment destination for foreign investment from two aspects. One is from the cross-border trading perspective, and the other is from the perspective of setting up onshore presence. Actually, I think the topic has been one that has been constantly deliberated and discussed by regulators and investors for a long time. Since China firstly allowed foreign banks setting up operational entities in China 30 years ago and allowing the first QFII to access Asian markets 20 years ago. It has been a long time. Time flies, and we have all seen how China and the International Financial Committee have connected deeply and widely ever since. Nevertheless, I believe you will all agree with me that today it's still crucial or even more important to discuss this topic further because of the challenges we are facing of the economic recovery after the pandemic and because of the necessity of China to further widen and deepen its opening up to the international community in the geopolitical environment. Okay, so now let's hear what the industry leaders say. Probably Dr. Huang and Ms. Cao, you can share with us first about the situation of the macroeconomy of China first to set the context of the discussion.
Well, it's a great pleasure to see many friends here, and thanks for ASIFMA to organize this important event after the COVID. I think that in the previous panel, there have been some discussion about the market economy. I think that from market perspective, this is also a very important issue. As of now, I think that China's recovery for this year, is not as strong as the market had expected at the beginning of the year. So I think that at the beginning of the year, many economists, raised their forecast, raised the growth forecast for China's GDP for the year. I think in light of the recent data, I think that they have been modified the growth forecast for the year. Having said that, I think that it's probably quite likely the GDP growth rate for the year will reach 5% or maybe slightly higher than that. The global growth is fairly weak for the year, according to the IMF. I think that many economies are in recession in European countries or heading towards a recession. Not recession yet, say U.S. economy. U.S. probably not be getting into inflation this year. My personal view is that probably even for next year, U.S. could avoid recession. But I think that growth rate is weakening. The IMF forecast for the GDP growth for the year for the world is about 2.9%. If you take that 2.9% at its face value, if you think about the China's growth rate at 5% and over, I think that the China's GDP growth rate contribution to the world for this year will be way over 30%. Okay, I think that means that it's really that it's an important economy that contributed to enormously 30% of the world growth. Okay, for the year. I mean, the global market should not ignore, and also the global market, I think that should, given the growth momentum, I think that increase its penetration into China. In the last panel discussion, my colleague Sui Li and others mentioned that really the decoupling risk is, I think, is reduced. Certainly, if you invest in emerging market economy, you always want to manage risks, right? I mean, for last year, there were exchange risks, there were other risks. For this year, there are other risks, geopolitical risks. But I think that China, from macro perspective, is so important to be ignored. And not only it cannot be ignored, I think that it should be a market that I think that for the year, I mean, for the foreseeable future, one should increase its investment or attention for research into China.
Okay, Mr. Chao.
Okay, thank you, Mr. Yu. I want to highlight 2 points. One is, China's economy size is 120 trillion yuan. The market size, including the bond equity, is around 144 trillion yuan. That means the equity market is 74 trillion yuan. For the fixed income side, is 144. So it is 218 trillion yuan. The total is 218 trillion yuan. So this huge market, it is very big. It is compared to the other market, it is ranked the number second. So it is a market you cannot be ignored. This is the first point. For the second point, I want to emphasize is China's bond market has been included in the global bond index since 2019. First is the Bloomberg Barclay Global Bond Market Index. Second is the JP Morgan Emerging Market Index. Also the Russell FTSE Russell Global Bond Market Index. For the bond market to be included in the Global Bond Market Index, it is a standard for the world investor, to look for diversification. One more I want to stress is the Chinese renminbi. Renminbi is a very important currency. It's a freely usable currency. It's not a fully convertible currency. You can remember in 1996, at the current account program, we realized the renminbi convertibility. In 2016, renminbi has been included in the special drawing rights of the IMF. It becomes the official reserve currency. So although it's not fully convertible, but actually for the capital account, more than 95% has been realized for the full convertibility. Just the derivative has not been included in this kind of the program. But actually for the investor, access to the mainland bond market, you also can use the swap connect, either derivative or the swaps to hedge your risk management. So I think for the China capital market, it is ready for the global investors.
Okay, thank you for Mr. Huang and Mr. Cao. I think Mr. Huang highlights that when assessing the attractiveness of a particular market, it's also important to actually compare with the performance of other markets. And what Mr. Huang and Cao have just mentioned also echoes what Julia has mentioned at the beginning of the conference, that China capital markets is too big to be ignored. Then let me turn to Mr. Zhong and Ms. Wang. What do you have seen actually in the market in terms of the investment activities of international financial institutions? Do you actually share the same views as the panelists? Yeah, let me pass my floor to Mr. Zhong.
Yeah, thank you. Very pleased to be here. I think if you look at the Chinese market, it's important to keep in mind, I would say, maybe two major regulatory developments. One, in 2018, it was the announcement of the asset management restructuring regulation. I think that has ignited a 4 or 5 years of restructuring of the sector. And that is a key because it set the foundations for what's going on now and what will be developing in the future. Second, in 2019, in July, State Council has published 11 measures in favor of the development of the financial sector, further opening of the financial sector to foreign capitals. So further to these two milestone regulations, on the one hand, we have seen a sustained process of cleaning up the financial sector, the asset management sector. And at the same time, with opening, China has attracted global firms into the market. The global firms have set up their majority-owned JV in the wealth management sectors with banks. And also global firms have embarked on multi-track development, including setting up the wholly foreign-owned fund management company on the back of a very substantial success of their JVs in the past. I wanted to remind you that out of the 140 FMC in China, you have 40-something JVs, and most of them are very profitable. I think this is really a very important lesson. It has started very early, more than 20 years ago already. And today, most of the JV firms are developing with a very strong, profitable record. So that's one key thing. The second thing is that obviously in the last 3 or 4 years, we have got COVID. We have also got more complex geopolitical situation. And because of that, clearly the growth has become slower. But I think it's very important to keep in mind that now it's very different from the last 4 decades with wild growth, rapid growth. But today we are on a much more transparent, clearer market platform. We are embarking on a slower growth, for sure, but of higher quality, a concept that has been referred to earlier in another panel. And also, it's going to be a more inclusive growth, more sustainable, of high quality, a growth that is more inclusive. So I think we have to have a view beyond the short-term period of adjustment and transition. So global firms that look at China obviously have to have this in mind so that they can also adequately plan their setup, their investments in order to be compatible with this new pace of the growth, which is very different, again, from the pace we have witnessed in the past decades.
Okay, thank you, Mr. Zhong. Let me invite Ms. Wang. What you have observed in terms of the investment activities of financial institutions, please.
Thank you, Grace. I'm sorry to have to dial in from China and happy to be a diversifier of the panel and discuss China from inside China. I think we always like to describe the market landscape in China from three perspectives, like three pillars of how we look at the China market, inbound, outbound, and onshore. So I will quickly walk through all the three pillars. From an inbound perspective, I think a lot of the previous panels and our two economics also talk about how China has been attractive to global investors. And we always know that how underrepresented China has been in global investors' portfolio. And these things has been gradually changing. We start to see the foreign ownership in Chinese assets like stocks and bonds has been seeing like 30% plus CAGR in past years, and which is faster than the growth of the total market capitalization. And also foreign ownership that we had always been talking about in Chinese equity and Chinese bonds had now doubled up to like 4%. So on the inbound side, we did see the market is gradually, international investors gradually taking up larger part in Chinese assets. And the other side, vice versa, is outbound. We also see that China has increased the connectivity with global markets. We always talking about in various forums that Chinese financial households, how similarly underrepresented global assets in Chinese financial households portfolio. But we are seeing things start to change a little bit, and people start to realize the importance of a global diversification in their portfolio. And for example, we see QD quarter increased by multiple folds from 31 billion in 2016 to 160 billion in 2022. Number of QDRP funds, which enable the domestic investor buy into offshore products, not only long-only products, but also hedge fund and other alternative products, has went up from 4 in 2016 to like close to 40 in 2022. And there are other kind of cross-border programs like mutual fund recognition. We have now close to 40 northbound approved products in mainland China, and industry are also waiting for the liberalization in the development of Greater Bay Connect. And the third pillar, last but not least, is what Mr. Zhong just talked about, the onshore market, which is definitely starting to becoming increasingly important for all of the global players. And we can see that Ms. Zhong talked about the wealth management products and also the asset management regulation, which was implemented in 2018. And all those driving the domestic markets continue to grow and evolve. And we start to see the mass adoption of mutual funds. And the mutual funds investors, public fund investors, the number of public funds investors onshore has risen from 270 million in 2016 to now like 720 million in 2022. So that's a massive growth. We also see a lot of the global asset managers, including ourselves, including Amundi, coming to build our onshore footprint, try to come into this fastest growing China market. I will pause here and welcome the more comments.
Oh, thank you, Ms. Wang. I'm sure that your list can go on and on if time permits. Actually, I think Ms. Zhong has very helpfully highlighted that when international financial institutions assessing the opportunities for investment in China also needs to take a kind of historical view to look at what China has gone through in the past 30 or 40 years, and what the market has improved significantly. Sometimes I would think that yes, please have expectation on China, but not too high expectation. We are already kind and doing as well as we can, and I think on top of the current activities, I would like to ask the panelists what further opportunities you anticipate that foreign financial institutions will have when they access Chinese market. Dr. Huang?
I think there are still plenty of opportunities for foreign, investors getting into China. I think that China is pushing for high quality opening up. High quality means, to some extent, I think that at least when I think about it, we need high quality investors. I think that's very important. Many of them, are sitting here. I think that long-term investors with quality, high quality money, with commitment, with deep understanding about the fundamentals, deep understanding about the governance issue, deep understanding about the market, all this will be very helpful to Chinese market. I think that's growing, but I think that that's still there's huge demand. More recently, as we know that some let's say foreign institutional investors and including investment banks, they got the new license from China. That's also showed that authorities in China certainly welcome quality institutional investors from the globe to invest into China. More recently, of course, if you think about the high level of risk by foreigners, from Europe, from the US, from the rest of the world, I think that they also represent the China's interest in basically attracting international investors. I think that of course CICC, I have to say something about my own firm, is standing ready to help to bridge the investment from foreign investors into China.
That's fantastic, Mr.
Okay, I want to say the corporate governance has been strengthened in China for some time. This is the key for the foreign investors to consider, for the article of association, for the board of directors, from the annual shareholders meeting, also from the policy and the procedure, and the fiscal risk management. Compliance has been strengthened a lot. This is good for the Chinese corporate company. Particularly, you can. There are 5,000 listed A-share company. Their operating performance last year around 73 trillion yuan is up 7% over previous years. Also, their research and development spending is around 2.5%. This kind of high quality support is a fundamental for the China capital market to grow. That's one. Another is for the green investment. China put a lot of attention to the green investment, sustainable investment, because we have the 2030 peak of the carbon dioxide, also the carbon neutrality in 2050. For the 5,000 listed A-share companies, 1,700 companies has compared and released their ESG reports. This, is for the investor, for the stakeholders, to check, to supervise their performance. Yeah.
Mr. Zhong.
I think one key set of opportunity is pretty much pension related. And KPMG and ASIFMA have published a report on China pension reform. One key indicator is that right now the pension assets in China only account for 10% of the GDP, which is very, very limited and moderate. And knowing that in developed countries, pension funds account for closer to 200% of the GDP. So that is clearly a set of opportunities ahead. The second one, as mentioned by Mr. Tao, clearly ESG related, climate related, net zero solutions will also be very significant in terms of opportunities for a wide range of actors or institutions, not only for asset managers, but for sure for asset managers. And then third set of opportunities related to the services, solutions, and technology in support of the growth of the asset management industry. With the new era that is unfolding, we can see so many more opportunities ahead. What we have got so far is just the beginning of something much broader and bigger. Thank you.
Thank you. Ms. Wang, please.
I'm not going to talk about one single opportunity, but to address the opportunity question, I was thinking that we look at China as opportunity for investment destination as well as for our business destination. So from investment perspective, we've been always talking about, but it's always stay true, that China, the Asian market, the bond market offer a big diversified for global asset allocators portfolio. I think that will be one driving factor to change global asset allocators portfolio in the decades to come. And we know that the correlation between Chinese bonds and the Chinese equity versus their global counterparts probably stay as low as below 0.5. And also alpha, we've been hearing a lot of our US clients talking about Chinese equities stay as last to be covered, like alpha opportunity for them. Not to mention that the market is still dominated by retail individual investors. There are a lot of opportunities for global investors. And also we think that Chinese Asia equity, for example, presents unique investment exposure, which people cannot find in other markets elsewhere. For example, like advanced manufacturing, solar, and other like energy transformation related companies, and Chinese consumption products and medical equipment, etc. So those are from the investment perspective. I'm sure there are a lot of experts going to address further on that. And on the business side, we also look at China as one of them, or even the fastest growing mutual fund, asset management and wealth management market in Asia or even globally. I think it's Mr. Zhong talk about the growth probably slowed down, and Mr. Cao talk about high quality growth. So even we look at the forecasted CAGR growth for Chinese mutual fund market or asset management market, the growth rate might slow down for the coming 5 years compared to past 5 years, but it's still double digits. And it's very rare to find such a growth in global asset management industry at this moment. So for any company that are keen to grow, I agree it's really very hard to ignore and walk away from this growth market. And not to mention the still to be locked growth potential in people talk about ESG, retirement, ETF, etc. And we also think that a lot of new regulation that we previously talked about also help to level play how people operate in China and minimize the gap between how we operate offshore. So that presents a huge opportunity for us from business perspective as well.
Well, thank you. That's very inspiring. Well, I think from what I hear from the panelists, certainly the very important I think opportunity or aspects need to always bear in mind is I think the soft investment environment in China has significantly improved over the years. Just mention about the more transparent market, the assets market being cleaned up, and also I think I probably can also add that if you look at the court judgment, actually one initiative from Shanghai Financial Court is that they are thinking to launch a kind of a pilot trial program, which means that even though certain concepts may not exist in the current PRC law, but if that law follows the widely recognized international standards, investors or market players can submit or file trial or trial application to the court and see what the court judges. So that's the kind of initiative to facilitate transactions, financial transactions, more closely to the international standards. And also, I think Mr. Huang also just mentioned that when treating foreign investments in China, we are not just offering national treatment. The regulators is also open to consider more kind of measures which will tailor or accommodate their unique characteristics of how international financial institutions operate. I think in the past, the CBIRC has already had a certain initiative in this regard to allow more kind of intergroup collaboration between onshore foreign bank and its group outside China. I'm sure that more favorable measures will come. So I think that's the soft environment. And then in terms of the opportunities, there are, I think, opportunities coming from the issues that are common across the world. For example, ESG and aging society. Certainly because of the vast capital markets in China, there are opportunities in China that you cannot ignore. And also there are China unique opportunities that investors can find out. So I think that's my take on from the discussion. Putting aside the opportunities, I want to ask the panelists, do you see or what any challenges or what challenges do you see when foreign investors invest in China? Maybe still start from Dr. Huang.
China is an emerging market. I think it is continue to open up. So there are challenges ahead. Rather going through the number of challenges, I think I will leave my colleagues, panelists to discuss. I want to tell you maybe two stories, okay? For those who are old enough, probably you remember a book called The Beijing Chip, is right? That was a joint venture between an American company and the Beijing Chip. And they ran into all kinds of difficulty. And, but the book painted everything about the Chinese firm that did not collaborate, and then the regulator, everything did not work out. That was not, well, the story, the pain, I think that, captured a lot of attention in the economist group and also in the investor group. That company in the end failed, but that was really a bad example. But if you think about later on, think about Ford Corporation, Toyota, BMW, Porsche, all those joint ventures with the Chinese company made so much money out of China. German car makers made more money out of China than Europe combined. Ford Corporation made more money out of China than the rest of the world combined. So I think that, so when it comes to challenges, one has to be, philosophical and then also take a long-term perspective. Another book I think that many of you probably heard of, if you are old enough, I guess, that was the book published before 2000 by Gordon Chang. He predicted that China would collapse. The coming collapse in China. If you really think about China's growth, 2000 was a critical year. That is China committed to join WTO. Everything started to take off. And in economics profession, in investment profession, there is no more mistake bigger than that. Okay, so talk about all challenges. Everything, all the challenges combined, that means that the economy would collapse. So I think that, so when it comes to challenge, I think that we need to be calm, and also that I think that China, on balance, offered more opportunities than challenges. Maybe as an economist, I want to offer two philosophical thinking and the two books. You can still go back to read the two books. I think the books are very well written. The problem is that the conclusions are completely wrong.
Yeah, I just want to say one thing, I used to be a portfolio manager for the US dollar denominated bond market, the American government bond market. I followed that market for many years. I'm a foreigner, but I think if you access to this market, you follow the market, you will reward a lot, And my experience told me, for foreign investor to look at the China capital market, I think it's just, from the risk management and the development, because China opened the financial market to the outside world, combining the risk management and the development. And we set up the Stock Connect, Bond Connect, Swap Connect. I think the important thing is to make this facility more market accessible, more intelligent, more easily to do business, to do trade. That's the key for our country's market facility providers to consider. Because we set up so many facilities, how to make them for the foreigners to access easily, to do transaction easily. That's very important.
From my perspective or on my radar, I would say that it's important to bridge what's happening in China and what the head offices of global firms think about what's going on in China. I want to be more precise. For instance, China is pursuing a different dynamic in the growth, is witnessing a different evolution. And ultimately, the destiny of the trade is that China will become a standalone, a bit uncorrelated market to the rest. So in order to capture the opportunities, you have to bridge the gap between what's going on in China and what it's the standard process in the head office. We're going to witness some sort of convergence, and we will see familiar evolution. But I don't think ultimately you can have a completely integrated market comprising China, Europe, or US. And this is why I think to sustain the growth in China, you need to navigate this environment. You need to bear this in mind and do what is necessary to bridge the different markets going forward.
Okay, thank you. Ms. Wang.
I always be the last but not least, run the risk of having to repeat what people already said. I think we talk about China growth and a massive opportunity, but it's, so if you get everything right, it's a super rewarding game. However, we have to know that it's not easy to get rewarded. And there are so many challenges. I have to repeat what Mr. Zhong said, but I want to remind everybody is I think the biggest challenge is for global players need to know that China is different, and China is so different. And you need to understand those differences. There are some things that just different, no right or wrong, just China is different. For example, people here, when they trade, they use local trading execution systems, and the culture, there are some difference in the culture, in the business practice. People like to use social media and people like to shop online, etc. So we need to understand those differences. But there are areas of differences because China is at an earlier stage of development. And then, for example, we always talk about, do we want to do long-term or short-term trading to pursue unlocking long-term investment returns or star manager culture, or in the wealth management products market, people still issue wealth management products with a point number as a benchmark, etc. So those are things that you need to decide whether you adapt to it or you wait until it comes to the way you are comfortable with. And there are also areas that's different because China actually is leading the way globally. For example, the use of digital platforms, how developed they are, etc. So I think that the biggest challenge for us is we understand those differences. And I know that Mr. Cao mentioned that we need to follow the market, but for us, we probably need to, if there is a spectrum with two ends, 100% local, 100% global, you need to find your time zone, your comfort zone, which enable you to stay competitiveness, but also enjoy the growth of this market. And you can decide if you want to come in now or later, but we always need to be mindful that Chinese will always be different. China will never be exactly the same way as a global other markets like US or Europe. So we do need to respect locality and stop being arrogant coming into the market. And we need to read the market well and well understand the risk behind all the differences and make sure that we have a proper risk-aware growth mindset. And also my last word is, there is actually no one set of solution out there, and every company should have their own business objective and to decide their own business strategy, how to address the market. But yes, it is a challenging market.
Well, thank you very much. Well, I think, thank you for the kind of very honest sharing. I was prepared that my panelist was about to say, well, the Chinese government needs to be more transparent and predictable. For example, in terms of granting licenses, why it take more than 2 years to get a license, and why kind of global, the way we do business outside China by a kind of inter-group integration doesn't work in China, all those kind of things. But it sounds to me that to the panelists, the biggest challenge is still the mindset when making investments in China. It's about the cultural difference and about recognizing the difference between China and elsewhere, and then to have a rewarding journey for investment in China. This, I think, also remind me of one note from Zhou Xiaochai in the Lujiazui Forum when he talked about RMB internationalization. When he said, when we design all the kinds of measures, etc., what really matters is what kind of mindset framework we take. So I think that is kind of a similar philosophy when we talk about the challenges. There are various challenges, but probably the biggest challenge is how we perceive all these challenges. So lastly, if I may, I would like to ask my panelists about one sentence that you consider the Chinese government can do to attract or further attract foreign investments in China. Probably this time,
Maybe
I will invite Ms. Wang.
Because we don't want to treat you as the least.
Yeah, Ms. Wang, start from you.
Thank you. It will be embarrassing if my one sentence was already said by other panelists. I think the most important thing is talent and senior talent. So we do want to think that it's very important for China, mainland China, to attract senior talents to the country. Probably the only way to, or the most important way to build a real global financial center. We need to facilitate global companies, their senior management be able to sit in Shanghai, sit in Beijing, sit in China, and still able to run their international and offshore regional business. So I think that's very important. That's my one sentence. Thank you, Mr. Huang.
Okay, your turn, Mr. Huang.
Oh, no, maybe in this order, yeah.
Oh, yeah.
Okay, now for me, I think what really matters is the quality of the communication. And that has different dimensions. One, tell the China story to the outside world, and then let more also foreign visitors go to China to see what's happening, instead of being influenced by papers, articles written by different outlets. So it's really key to get people together. And basically, this is the essence of the business. People doing business together, improving a mutual understanding, improving the quality of the communication, and improving the comprehension. Thank you.
I want to say is listen to the investors' concern and take actions. That's all.
Last and not least, capture the opportunity and judging the risk rightly and manage the risk well. Last and not least.
Well, certainly not last list. I think thank you very much. I actually see the representative from Chinese regulator, Mr. Huang, was nodding his head very seriously when he hear all what the panelists have been saying. Yeah, I think the discussions will not end. We can still discuss after this conference, and I'm sure that investment activities in China will continue to grow. Thank you. Thank you.
Thank you. Thank you.